Well, you have extra time this year to get your taxes in, but not too much extra. The clock is ticking to file. Back again with us, Paul Schatz, president of Heritage Capital, LLC. Thanks for being with us.
Thanks for having me.
Let's start first and foremost. What do people need to know? It's crunch time.
Well, most important, you better file your taxes by April 18th, or you're in a world of trouble. And if you can't file by then, most importantly is you got to file the extension. You'll get a 6-month extension, but if you owe tax, you have to pay your tax by April 18th. You can file the return later on, but pay your tax by the 18th.
Okay. Are there certain things that people should be doing when it comes to taxes? You know, let's talk about IRAs. Should you open up one ahead of time as you file to help you save money? Is it something you should do after? Given that
it's crunch time, there are only a couple of things left that you can do to reduce your tax rate. One is you can open an IRA, what's called a traditional IRA. It's pre-tax, meaning you do not pay tax now. You can invest up to $5,500 if you're not covered by an employee retirement plan like a 401k. So it's $5,500. If you're over the age of 50, the government says you can add another $1,000 as a catch-up provision. So you can add $6,500 if you're over the age of 50, and you can deduct that from your tax bill. So that's a really good help. Everyone should have an IRA. There's also a Roth IRA, which I think is even better. A Roth IRA you fund after you pay tax on the money, which means you don't get to deduct it. The same $5,500 if you're under 50, $6,500 if you're over 50. The difference is with a Roth IRA, all the money grows tax-free. You don't pay any tax on it. And then when you take it out of your Roth IRA, when you're 59 and a half or older, the money comes out of your IRA tax-free as well. That's the best one.
Okay. Can you still do that if you are under a 401k plan with your employer?
The answer is yes. There are income limits. So rather than really complicate the issue right now, it's a tiered income structure. But if you can do a Roth, I recommend everyone do a Roth. And also, health savings accounts, HSAs.
Yes, another big
If you have a high deductible insurance plan, an individual can put in $3,350 and a family can put in $6,750. You can put it in until April 18th and deduct it from your 2016 taxes.
What about celebrating your tax refund? I know I've done it in the past. I've been like, yes, I get money back. Obviously better than paying the government, but it still means that you're giving them a free loan.
Everybody celebrates getting a big fat check from Uncle Sam, but you shouldn't. What you want essentially plus or minus a couple of $100 to $1,000, because if you're getting a big refund, you just gave Uncle Sam interest-free loan.
Right.
Why do that?
Right.
Keep the money yourself. With rates going up a little bit, you can get 1.5%. Don't give Uncle Sam the money.
All right. Well, thank you so much. We could go on forever and ever and ever talking about this.